You're scrolling through social media when you see it. Someone just turned $500 into $50,000 in 3 weeks. The screenshots look real. The testimonials are glowing. Your heart races. This could be your chance to finally get ahead, to quit that job you hate, to live the life you've always wanted. But here's what nobody tells you. The difference between wealth building and financial devastation often comes down to recognizing a few critical warning signs. And if you miss them, you could lose everything. Today, I'm going to show you exactly what professional con artists and unethical promoters don't want you to know. The 7 red flags that scream walk away before you hand over a single dollar. Number 1. Guaranteed returns with zero risk. Let's start with the biggest lie in investing. Guaranteed returns with no risk. If someone promises, you'll definitely make money, whether it's 10%, 50%, or 500%, without any possibility of loss, you're looking at either fraud or delusion. Here's the reality. Every legitimate investment carries some level of risk. That's not pessimism. That's how markets work. Even U.S. Treasury bonds, considered among the safest investments on earth, carry inflation risk and interest rate risk. When someone guarantees returns, they're either lying about the investment itself or they're running a Ponzi scheme where early investors get paid with money from new investors. Bernie Madoff promised consistent returns for decades, and he delivered them until he didn't. Thousands of people lost their life savings because those guaranteed returns were pure fiction. Professional investors know this rule. If the risk seems to have disappeared, it hasn't. It's just been hidden from you. The greater the promised return, the greater the risk should be. When someone flips this equation and offers high returns with low or zero risk, your internal alarm should be deafening. Number 2, pressure to invest immediately. Legitimate investment opportunities don't have countdown timers. When someone tells you that you need to decide right now that this offer expires in 24 hours or that there are only 3 spots left, they're using a classic manipulation tactic. This manufactured urgency exists for one reason: to prevent you from doing what every smart investor does, taking time to research, consult with advisors, and think critically about the opportunity. Real estate deals, stock investments, business ventures, and legitimate opportunities will still be there tomorrow, next week, or next month. In fact, most professional investors insist on due diligence periods precisely because good decisions require time and analysis. The pressure tactic works because it triggers your fear of missing out, that gnawing anxiety that everyone else is getting rich while you're being left behind. But here's what you need to remember. Scammers need you to act before you think. They need you to let emotion override logic. The moment someone says, "You need to decide now," the best decision is almost always to walk away. Any investment worth making today will be worth making after you've had a chance to verify the claims, check credentials, and sleep on it. Number 3, vague or incomprehensible investment strategy. Ask a legitimate fund manager what they invest in, and they'll give you a clear answer. They invest in dividend-paying stocks. They focus on emerging market bonds. They buy undervalued real estate in growing cities. Now ask a scammer the same question and watch what happens. You'll hear buzzwords like proprietary algorithm, advanced trading systems, or cutting-edge blockchain technology. You'll get explanations that sound sophisticated but mean absolutely nothing. When you ask follow-up questions, the answers become even murkier. This isn't because the strategy is so advanced that you couldn't understand it. It's because there is no strategy, or the strategy is illegal. Warren Buffett, one of the most successful investors in history, has said repeatedly that you should never invest in something you don't understand. If someone can't explain their investment approach in terms you can comprehend, they're either incompetent or they're hiding something. And here's the test you should apply. After someone explains their investment strategy, can you turn around and explain it to a friend in simple terms? If you can't, you don't understand it well enough to risk your money on it. Complexity is often a smokescreen for fraud. Number 4, unregistered sellers or unregulated investments. In most countries, people who sell investments need to be registered with financial regulatory authorities. In the United States, that's the Securities and Exchange Commission, or the Financial Industry Regulatory Authority. Other countries have equivalent bodies. This registration isn't just bureaucratic red tape, it's your protection. Registered advisors have to follow rules, maintain certain standards, and face serious consequences if they defraud clients. When someone selling you an investment isn't registered, or when the investment itself isn't regulated, you've lost that safety net. Now, some investments are legitimately unregistered, like certain private placements or investments limited to accredited investors. But these come with clear disclosures about the risks and the lack of regulatory oversight. The red flag appears when someone actively avoids questions about registration, gets defensive when you ask about regulatory compliance, or assures you that registration doesn't matter because their returns are so good. You can verify registration in minutes with online databases. If someone selling you an investment can't provide registration numbers or gets upset when you want to verify them, you have your answer. Legitimate professionals expect these questions and welcome them because they prove you're a serious investor doing proper due diligence. Number 5, testimonials that are too perfect. Success stories are powerful. That's why scammers use them so effectively. You'll see videos of people standing in front of rented Lamborghinis, screenshots of bank accounts with enormous balances, and testimonials from average people who struck it rich. But here's what to watch for. When every single testimonial is positive, when everyone made money, and when nobody experienced any problems, you're almost certainly looking at fabricated evidence. Real investments have mixed results. Some people make money, some break even, and some lose. Customer experiences with legitimate investment firms include complaints about fees, communication issues, or market downturns that affected returns. This variety is a sign of authenticity. The perfectly curated collection of success stories with zero negative reviews is a manufactured narrative. Professional scammers know that fake testimonials are easy to create. They hire actors, fabricate screenshots, or simply make up entire personas. Some use real people, but only showcase the winners while hiding the dozens or hundreds who lost money. Before you trust testimonials, dig deeper. Can you verify these people exist? Can you contact them independently? Are there any negative reviews or complaints anywhere online? If the answer is no, you're probably looking at a carefully constructed illusion designed to separate you from your money. Number 6, complex fee structures or hidden costs. Fees in investing are normal and expected. Fund managers charge management fees. Financial advisors earn commissions or charge for their time. What's not normal is when you can't figure out exactly what you're paying or when new fees keep appearing that weren't mentioned up front. Warning signs include investment opportunities, where the fee structure takes several pages to explain, where fees are described in vague terms like standard industry charges, or where you're told not to worry about fees because the returns will more than cover them. Here's why this matters. Excessive or hidden fees can destroy your returns, even if the underlying investment performs well. If you're making 8% annually but paying 6% in various fees, your actual return is only 2%. Some fraudulent schemes use complex fee structures to extract money from investors while making it difficult to track where the money actually goes. Legitimate investment opportunities provide clear, upfront disclosure of all fees. You should be able to see exactly what percentage goes to management fees, what transaction costs you'll pay, and what other expenses might come out of your returns. If you have to keep asking questions to understand the costs, or if the person selling the investment seems evasive about fees, you're probably being set up to pay far more than you realize. Number 7, exclusive opportunity or inside information. Here's the final red flag. When someone tells you about an exclusive investment opportunity that only a select few know about, or when they claim to have inside information that will make you rich, they're setting you up. In legitimate markets, truly exclusive opportunities go to institutional investors, wealthy individuals, or people with specific professional credentials, not to random people responding to social media ads or unsolicited phone calls. When someone approaches you with an exclusive opportunity, ask yourself, why me? If you're not a high net worth individual, if you don't have special expertise, and if you didn't seek out this investment yourself, why would you be offered something exclusive? The answer is usually that it's not exclusive at all. The same pitch is being made to thousands of people. And inside information? Trading on material non-public information is called insider trading, and it's illegal. Anyone actually offering you inside information is either lying or confessing to a crime. Either way, you should run. Real investment opportunities are accessible through normal channels. They're vetted by professionals. They have track records you can verify. They don't require you to be in the know or part of some special club. Your financial future is too important to gamble on schemes disguised as opportunities. If you've recognized any of these 7 signs in an investment you're considering, step back and do more research. Consult with a registered financial advisor who has no stake in the investment. Trust your instincts. If something feels off, it probably is. And remember, building real wealth takes time, patience, and smart decisions. It's not glamorous, but it works. Protect yourself, stay informed, and never let someone else's urgency override your own careful judgment.